Welcome to Morning Markets. I'm Lindsay Biscaya. Here's some of the stories that we're tracking for you in the BNN Bloomberg newsroom. Shares of Eldorado Gold and foreign mining are taking a hit today. Eldorado is buying foreign mining for $3.8 billion to create a gold and copper mining company. Some analysts note the transaction may raise concerns, though, about Eldorado adding more startup projects and integrating a copper-focused asset. The deal will bring together development projects in both Greece and Saskatchewan, and the combined company will remain headquartered in British Columbia under the Eldorado Gold name. 5N Plus is one of the best performing stocks on the TSX today. That's after the semiconductor and materials producer says it plans to expand its solar cell production capacity by 25% this year. 5N says the increased capacity is expected to gradually come online in the second half of the year. And this comes after the company received an $18 million investment from the Pentagon to extend its uranium refining capacity in Utah. And U.S. President Donald Trump is getting ready to launch a strategic critical minerals stockpile. According to Bloomberg, the $12 billion stockpile is aimed at protecting manufacturers from supply shocks and cutting America's reliance on Chinese rare earths and other metals. The reserve will include minerals such as gallium and cobalt, which are used in products like iPhones and jet engines. And we'll take a quick look at the markets here. The TSX is up today, 0.5 percentage point after seeing some real lows on Friday, rebounding a little bit. If we look at the U.S. markets just south of the border, oh, we're not going to look at those today. Okay, we're just going to move right on. Markets are rallying today after last week's sell-off, but is the rebound sustainable, especially with growing scrutiny around AI-related spending and return on investment? Chad Larson, Senior Portfolio Manager with MLD Wealth, joins us now to unpack it all. It's good to have you in studio. Thanks for joining us.
Thanks for having me today.
So what do you think matters more when we're looking at the earnings season, headline beats or actual credible guidance?
You know, I think it's less about beats and misses and more about guidance, credibility. We started in a marketplace of what I think it's a transition between what we're calling like prove ROI versus an infinite TAM. And that's jargon that we use. Like TAM is the total addressable market. And that's something AI for the last number of years, everyone's like, it's going to be huge. And I think the reality is it's how big the opportunity could be. And we know it's big, but now it's prove ROI. It's prove the return on investment. And we saw that with Microsoft earnings last week. It's a big company to be down more than 10% in one trading session. I think that's the street really looking at show me the money component. Is structurally the trend still intact? It is, but now it's more structured and staged. So I think one of the things we saw over the weekend with NVIDIA pausing a little bit and maybe putting a bit of a damper on the potential $100 billion deal with OpenAI is it's still happening, but it's going to be staged and prudent. So some more calmness or pragmatism is coming back into the marketplace.
Do you think that seems to be a concern as we head into 2026? Is that like the potential for overspending when it comes to these companies kind of spending on AI and trying to get things off the ground?
Absolutely. I think, we're all kind of, drinking the Kool-Aid, so to speak. Right. And we look at the Meta and, NVIDIA and Google and this big spend out. I think the number was closer to $390 billion was pushed out last year in CapEx. That's the equivalent of government stimulus into the marketplace. That has meaningful impact. So we know the party's going, it's all happening, but it's going to be this show me moment. And I think that's on the durability of consumer demand and some of these like AI taxes that are coming in, like really looking into Apple's earnings is the cost of memory is coming up significantly. Yeah. And so is the consumer, are we going to be as durable to these increases in costs for the increases of compute power and the critical minerals that go into this? Yeah. I think what Donald Trump is doing is prudent, and we're seeing that scarcity theme play out in the marketplace. It's not just about technology. It's going to be about the things that go into them to make them happen, whether it's copper, whether it's critical minerals, rare earth metals, whether it's going to be the data distribution, the power lines, all of these things are going to play into it. So.
Sorry, I didn't mean to cut you off there. Another big company we're watching for this week, Palantir. Is there anything in particular you're watching for with this company, especially when it comes to like gauging real commercial AI demand?
Absolutely. Like, I think Palantir's earnings are the litmus test of the narrative movement. It largely is traded on momentum and excitement into what's happening. But we really need to see like increased order books, recurring demand, increased order log books. Is the hype real? Are we able to scale the consumer into this? So we know the investment's going to come and there's going to be that backlog, but is the consumer there?
Another company, I know you touched on this already, Apple, of course, reporting earnings last week and talking about, warning customers that prices are most likely going to go up. When it comes to that cost increase that we could see with Apple, for example, where do you think that comes from? Like, is that tariff related? Is that like AI related components and materials like copper and stuff that you need for those?
That's a great question. I think it's all three, and two things can be true at the same time. I mentioned kind of what you're seeing as an AI tax is all of the input costs that go into this. They're becoming more expensive because more dollars are chasing them. That's basic supply demand. So the input materials that are going into them, are becoming more expensive. So how do they push that down onto the consumer? And will you and I, as consumers, remain durable in the face of increased cost for our hardware to access our softwares? And the next choke point that we're seeing is going to be largely on power. And I think the AI boom is really an industrial boom dressed up with a tech label. I think the scarcity of the rare earth metals, the copper, the electrification story, and the power is going to dominate. And I think that's the choke point into this next phase.
Well, you wonder too, like where customers' patience is going to run out if you're paying higher prices for everything. People obviously don't want to do that, right?
Yeah, I think the customer is going to be very durable. I think I turned my phone off for the interview, but the cost of my cell phone now is probably more expensive than the laptop I use at my desk. It's become critical infrastructure of how you and I engage in everyday life. So I think the consumers will remain very durable, but it's going to be this show me market. It's going to be when does the investment turn into cash? I lend you money, no problem, or I invest in you, no problem. And I think what's happening, and I'll go back to Microsoft, I know you're going to pay me back. I know I'm going to make an economic return, but when? And I don't think the market's frustrated yet, but I think the duration and the time for that investment to turn into real cash flow and earnings is probably a little longer than people expected.
Okay, going back to the markets as a whole, another thing we're watching for today and watching is the price of gold. We saw it plummet on Friday. I think it was the lowest plunge that we've seen since in
83.
a decade. Yeah, okay, since 83. Yeah. What do you make of what we're seeing with the price of gold? Should investors be worried, or is it just like a blip?
Listen, structurally, I would say like as of last Friday, I'm very exposed to gold. So Friday wasn't lovely, but I think I saw the best way, and I think he or she who tells the best story wins. And I've made a career out of making the complex, seem more simple. But there's a Matthew McConaughey meme where he's driving the Lincoln, he's handsome, and he's cruising on the open day, and it said gold $4,800 an ounce. And then it was Matthew McConaughey and Dallas Buyers Club, like looking disheveled and falling apart. It's like gold at 4,800. Yeah. Things have gone so well. I think structurally things got a hold of themselves. There's a lot of margin, speculation. One of the gentlemen that works for me showed me a picture in our local market of people lined up outside, a store where they could buy physical precious metals. So things swing too far in either direction. But listen, the analogy I would make is, I'll bring it back to the oil markets. If we had $150 oil right now, it would be, amazing for an oil company. So it corrects to 130. Who cares? Gold just ran so fast structurally from a scarcity geopolitical standpoint, a debasement trade at the Fed against a weaker greenback. We saw Trump, nominate a new Fed chair, Mr. Warsh, and has typically been more hawkish. But this has been 10 steps forward, 2 steps back. So being worried today, again, like and that's why sometimes I always hesitant to talk about earnings. This is a moment in time. Is the cycle and is the structure make sense? And I think gold will remain strong, but obviously have a lot of volatility. Things move up too fast.
Yeah, for sure. Okay, well, that's all the time we have. Appreciate you coming in. Thanks so
you.
much. That was Chad Larson, Senior Portfolio Manager at MLD Wealth of CG Wealth Management. Well, last week we saw a sell-off in precious metals, as we were just talking about, and we'll get more on the outlook for gold and silver when we come back. Stay with us. Markets opened lower today after a sell-off in precious metals last week. Gold was down 10% at one point, while silver fell by 15%. Both metals have been able to regain some ground since those lows, but prices remain volatile. And for more, we were joined earlier by Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth.
Love gold and silver and materials long term,
right?
But many of them have gone too far too fast. And they can correct for whatever reason when they go parabolic, and when they do, they're violent. I think gold and silver are now in a corrective phase. Let's just let this settle out. Everything's okay. Gold's going to be 10,000 by the end of the decade. There's no need to rush. But at the same point in time, you've got to understand that the market does get emotional on the upside and on the downside. And you just have to quell your emotions and take what the market gives you.
Why will gold go to 10,000 by the end of the decade, Jim?
Well, I think there's this view that fiat money and excessive amounts of debt, the big trade that we have talked about through all our whole career, Andy, is finally coming to fruition. I don't think that's going to go away. With the president nominating Warsh as a new Fed chair, we're in a new era, but it's going to take some time. And so I would expect, this theme to last until the end of the decade. So, I've always suggested that you have 5 to 10% gold in your portfolio. And I do not dissuade anybody from doing it. But if you have a 10% position in it and it's up 200 to 300%, you should trim it back just for risk control. Bird in the hand's worth two in the bush.
That's right, because it's going to bring you to a 20, 30% weighting in your portfolio.
Yes.
And so you think your thesis is that G7 industrialized countries will not be able to control their spending and their debt?
It's going to take some time. And I think the interesting thing about Warsh being nominated first is the fact that Prime Minister Carney applauded the decision. And I think Carney and Warsh worked together in 2008 during the financial crisis. So against all the noise that this is a terrible decision, the Prime Minister, I think, is right in what he's doing. And I think the Prime Minister is doing the best that he can in a very difficult situation. But having said that, you've got Warsh is basically into AI, and he realizes that AI can reduce deficit spending and fraud in government. And then he's also buying into the Bessent-Trump view that we're shifting away from Keynesian economics, which is only focused on the demand curve, to the supply side, deregulation and tax cuts. And I just wish that Tiff Macklin of the Bank of Canada, looking at the economic data, and I was in New York last week, but I finally caught up to his Q&A, and he's sitting there saying, there's nothing the Bank of Canada could do. Well, Warsh would say, yes, there is, because we're focused on helping productive capital and manufacturing. Whereas in Canada, manufacturing is falling off of a table, and Macklin is saying he cannot do anything about it. There is the juxtaposed decision. Macklin is living in the dark ages, and we're getting Warsh. Now, the problem is, Andy, this is going to take time. And in this just-in-time life that we live in, people might get impatient. But you can clearly see where the Americans are going and central bank is going. And you can clearly see that Prime Minister Carney, whether he likes to admit it or not, knows exactly what's going on.
Although Canada has already cut rates a lot more than the States.
Fair point.
But you think they should be doing more anyway.
Right. The argument is, what is the neutral rate? And it's some, R star. And so when you have negative immigration and you have our manufacturing dropping off, I suggest that you need to be loose. And the Bank of Canada isn't loose. Same with the Fed. And I think Macklin is hanging his hat on the Jay Powell, Janet Yellen, Ben Bernanke era, which is wrong. Market-based measures of inflation in the United States, that takes out all the junk, under 1%. And I would suggest the same is happening here. So all I'm saying is the neutral rate in Canada is about 1.5%, and he's got to get it down there. And there are reports out there saying that if he doesn't cut, we're going to have 100,000 job losses in the real estate market. So as far as I'm concerned, I think Macklin is acting a lot like John Crow did in the end of the mid-'80s.
Keeping rates stubbornly high.
Stubbornly high. But then at the same point in time, I think Carney knows exactly what's going on. And I wish Carney would pick up the phone and talk to Macklin and bring him up to speed on what's really going on.
That's interesting. I wonder, do they talk? Do the Prime Minister and the Bank of Canada ever and the Governor ever talk?
Well, they talk, but I don't know.
No, yeah.
I'm sure Mr. Carney is not phoning up Mr. Macklin and saying, hey, get with the program. This is what's going on. But, Andy, the point I'm making is, what does the Bank of Canada do? I mean, I'm a one-man band, right? I'm a chief economist and I'm a strategist. I figured it out. The smart money in New York's talking about this. It's not about hawks and doves anymore. It's about a regime change that's going to affect us for a long period of time. It's like we're in the early 1980s. What the Bank of Canada is doing, I have no clue.
And when you say a regime change, this rapid movement of manufacturing back into the United States, for example, Jim?
The regime is, Tiff Macklin thinks that inflation is caused by demand increasing and wages going up. And the regime changes inflation, a la Milton Friedman, is caused by excessive government spending and money creation. So if you focus on the supply curve, which is what Trump is doing, right? You cut taxes, you help out the industrial area, the supply curve moves out. You have a shift in the supply curve, and it's, I would say, economics 101, or if the brokers out there, this is in your CSE handbook to get licensed, guys, right? You shift the supply curve out, down the demand curve, prices go down, output goes up. How Macklin and the Bank of Canada don't see this is beyond me.
That was Jim Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Coming up, we will have a look at what stocks are in the spotlight today with Bloomberg's Monique Mulima. That's right after the break. Welcome back. For some of today's market drivers, we're now joined by Bloomberg equities reporter Monique Mulima. Monique, good to see you. Thanks for joining us. So first up, we've got that big deal in the U.S. energy space today between Devon and Coterra. What's going on there?
Hi, yes. So like you mentioned, Devon and Coterra, they announced a deal today. It will be a merger that has a value of about $58 billion US dollars. And these two energy companies are going to be seen a lot of growth out of this. Analysts are expecting the deal is expected to be accretive, and it's going to expand their presence in the Permian Basin. But we're seeing a divergence in share moves today between the two companies. Devon is currently up, while Coterra is down. And analysts say that this is due in part to the value that was assigned to Coterra in the deal. It's at a 2.4% discount to Coterra's closing share price on Friday. And analysts are just having a bit of concerns about this because Coterra had been recently outperforming, and that's what's weighing on the shares today. But they still think that this is a positive deal overall. It's seen as kind of a merger of equals, and they see a lot of opportunities for growth for these two companies together going forward.
Okay, and we also saw Bitcoin falling over the weekend. Now crypto stocks seem to be under pressure. What can you tell us?
Yes, so Bitcoin, it fell quite a bit over the weekend. Over the past 5 days, it's fallen as much as 14%. So this is a big move down for it, falling to prices that it hadn't been at since April. And that's really weighing on these crypto shares. We're seeing MicroStrategy, which now goes by Strategy. Their shares are down today, also at the lowest price since April. They're a Bitcoin accumulator. And we're seeing the crypto exchange stocks also lower. We've seen a lot of pressure in crypto markets recently as people have been moving away from risk assets, as there's been more geopolitical tensions, US dollar strength, and some other macro headwinds. And some of the pressures, analysts say, are also coming from outflows from Bitcoin ETFs. So that's putting pressure on the tokens themselves. But for these stocks that either hold these cryptocurrencies or run exchanges where people buy and sell these cryptocurrencies, whenever there's pressure in the markets or whenever there's less people transacting, that's going to weigh on their shares.
Interesting. You're also watching rare earth stocks today after Donald Trump reportedly is considering a critical mineral stockpile. What else are you hearing from the White House about this?
Yes, so Bloomberg reported this morning that Donald Trump is looking at creating a $12 billion critical mineral stockpile. This will be more on the commercial industry side versus there's already some stockpiling in place for the defense industry. This is something that analysts say is going to be really positive for the rare earths industry. Currently, China produces most of the world's rare earths and critical minerals, and the U.S. really wants to reduce their reliance on China for these assets. So that's why we've seen them over last year investing and taking some stakes in some rare earths companies. And now this is the U.S. moving even further. Some of this money is going to be coming from private capital. This isn't all just government funding. But analysts say that this could signal that there might be more government supports coming forward in the future, that if this is a top priority for the administration, maybe we will see some more investment in the industry. So the rare earths companies like USA Rare Earth or Critical Metals, the ones particularly in countries that are allies or are the U.S., so like the U.S., Canada, and Australia, their rare earth stocks are seeing gains today.
Okay, well, to keep an eye on that, Monique, thanks for that. That is Bloomberg's Monique Malima joining us live. Well, a small village in Quebec hosts critical mineral deposits that could be vital to Canada's self-reliance. CTV's Geneviève Bushman has more in this report.
Saint-Michel-des-Saints is a small village on the edge of Quebec's vast forests. Its critical mineral deposits could put it on the map of Ottawa's New World Order, this by boosting Canada's self-reliance. Quebec mining company, coincidentally called Nouveau Monde or New World Graphite, hit pay dirt here more than a decade ago.
Our metal detectors was beeping throughout the fairly large area.
Graphite says the company has many uses, including in the defense and EV battery sectors.
So it's about 4.5% grade.
Founder and CEO Éric Desaulniers says that for now, Asia dominates the graphite market.
And the benefit to Canada and all G7 countries is to have a stable source of this critical minerals, but also at the right cost point.
Last year, the mine's financing hit roadblocks as several companies in the EV supply chain faltered.
This is the graphite.
But a test plant is up and running, and in November, Ottawa recognized the mine as a major project of national interest. The federal and provincial governments have invested. To go full steam ahead, the mine still needs to secure financing. Some have opposed the mine, fearing environmental fallout, but the Atikamekw First Nation of Manawan has since signed an impact benefits agreement.
Ouais, c'est ça.
And the mayor of Saint-Michel-des-Saints says he hopes the project will go ahead.
Ça va fleurir à Saint-Michel-des-Saints.
It will bring good-paying jobs to our region hit hard by U.S. tariffs on forestry, says Mario Venn. Families will return and our town will bloom.
This is where you're going to have all the machinery.
Kevin Ducharme is the mine's environmental director. He moved to the region years ago for its lakes, its forests.
It's normal to have concerns with a project like that. We're not in a mining region. People are not used to seeing mines.
He says the company is banking on the best mining practices, the best monitoring systems. There are still many steps to go, but the target date for commercial extraction here is the end of 2028. Geneviève Bushman, CTV News, Saint-Michel-des-Saints, Quebec.
Just ahead, we will get a preview on what to expect from Amazon and Alphabet earnings this week. That's next. Shares of Eldorado Gold and Foreign Mining are taking a hit. Eldorado is buying Foreign Mining for $3.8 billion to create a gold and copper mining company. Some analysts note the transaction may raise concerns, though, about Eldorado adding more startup projects and integrating a copper-focused asset. The deal will bring together development projects in both Greece and Saskatchewan. Dye & Durham says it saw a loss of $88 million in fiscal 2025 and reported revenue of just over $100 million in the first quarter of this year. The financial filing is expected to revoke a trade order issued by the Ontario Securities Commission in December, and Dye expects its shares to resume trading on the TSX. Dye says it will outline its full strategy at a shareholder meeting in March. Tyson Foods reported sales and profit in its latest quarter that topped Wall Street expectations. However, the meat producer's beef business reported a $143 million loss in the quarter, and Tyson says it will close a beef plant in Nebraska. As a result, the company narrowed its expected operating loss in its beef segment, but maintained its outlook for the year. And we'll take a quick check on the markets. The TSX is currently up by 0.6% today after suffering a bit of a loss on Friday, down more than 1,000 points. You can see today it's trending a little up to start the week. And if we do take a look at U.S. markets, the S&P 500, the Dow Jones, and the NASDAQ all trading slightly up today, but all below 1 percentage point. Amazon and Alphabet are set to report their latest results this week. Earlier, we sat down with David Dietz, Chief Investment Strategist at Dietz Wealth Management Group, and we kicked things off with a recap of another tech giant who reported last week. That was Apple.
They have been all-time legendary winners, and the question is, where do they go from here? There's kind of in slightly different situations. One, of course, Apple's highly dependent on the iPhone sales. By all accounts, the new version 17 is doing extremely well. Mm-hmm. But on the other hand, of course, people have choices. They've got the Samsung, they've got the other brands, mm-hmm. and of course, at this point, it's all about what are the capabilities of the phone. Apple has lagged a little bit in terms of incorporating AI capabilities into the phone. And of course, that's one thing we're going to be watching. There's also been a knock on the iPhone 17 that's not really that much better than the 16. Nevertheless, people are buying that. And of course, we also need to look at the all-important service aspect, the various apps and so forth from via the App Store that they're selling, which has a higher margin, higher growth prospect. We need to hear from them on that.
Yeah, I'm just looking here at a 5-year comparison between the two stocks. Apple has been a double over 5 years, whereas Amazon has been a laggard. It's up only 43%. I wonder why. Is that partly because of concerns about competition from the Chinese e-commerce players?
Well, that's one aspect. The other aspect, of course, is valuations, where Amazon has always had a nosebleed valuation. For the most part, even people like Warren Buffett said Amazon has been just a fantastic company, but you are paying at certain times price-earnings ratios that were approaching triple-digit levels. Mm-hmm. So I think that's one reason that there's been a difference in terms of outcome. Apple, for example, when Warren Buffett's Berkshire Hathaway started buying it, it was down in the low teens price-earnings ratios. Now, of course, it's a lot more expensive. So that's one thing to watch. In terms of Amazon, of course, they've got two great businesses. They've got their hyperscaler cloud business that they're marketing very successfully. They're a leader there. Mm-hmm. They've also got the Amazon store, where, of course, they started with books. Now they sell everything, mm-hmm. and now they'll sell everything on the part of third parties as well. That's a lower margin business, but still, AI is stalking all these companies, and of course, they're trying to make strategic investments with AI partners because they need to incorporate that rapidly into all of their businesses. That's not going to come cheap. We heard from Microsoft last week that if you spend too much and can't show the results, there's going to be a nasty sell-off. But we also heard from Meta last week, where if you spend a lot and can show Wall Street the results in terms of profitability, you can fare very well with your stock. And so that's what we're going to be looking for with Amazon.
Amazon, of course, put something like $70 million into that movie about Melania Trump. Will you be going to see that one, David?
It's not on my calendar, but it's all about what my wife wants to see. I'll be quite honest with you.
Okay, that's a good policy. All right. You have some stock ideas for us. Humana, it's been tough on the health insurers, but you see upside here.
Yeah, so Humana's down about 2/3 from its all-time high. I like Humana because it's in one of the best areas of the healthcare business. It's in healthcare insurance. It's focused on seniors. It's also focused in the Sun Belt area of the United States, which is gaining population. So the problem with Humana is also its forte. Its forte is the so-called Medicare Advantage. In exchange for having a restrictive network of doctors that you go see, you pay less. You have caps on your out-of-pocket costs. You can get dental. You can get vision. You can even get gym memberships. That's very attractive to America's seniors, which is the fastest growing demographic here. And so their business is going leaps and bounds. However, they need to get reimbursed from the government. And unfortunately, the government's coffers are under pressure, and they just announced, instead of the 4 to 5% increase in the reimbursement to the Medicare Advantage players, something that's about zero. Well, who knows what's going to happen? But to me, it sounds a lot like those initial, back in April of last year, those initial ginormous tariffs, which were initial negotiating posture, and then of course Trump retreated. And I think we could see that here, because at the end of the day, the insurers are going to make money. They're just going to have to reduce the benefits if they don't get the right reimbursement. That won't make seniors happy. Seniors vote. So I think that the downside here with Humana is a lot less than the potential upside if the government relaxed those reimbursement policies.
Campbell's, that stock's been under pressure. And of course, the packaged food companies have had trouble in some cases from generic competition.
Yeah, absolutely. And artificial dyes, and they've been the punching bag for everything unhealthy in America today. However, at this point, you're at about a 10-year low with the stock. Wow. It's trading about 11 times earnings. It's going to generate about $8 billion in revenues, but it's only a $6 billion company. You've got a nice 4% plus dividend. I think this is a situation where they've got new leadership in there. They can cut costs. They can stay really focused. Of course, their snack business, I think, is very profitable. You got your kettle chips, you got your Cape Cod chips, all those things that we probably shouldn't like as much as we do. So I think you've got some iconic brands on sale. I think the consumer staples area could well take the baton if, in fact, people continue to kind of shift out of the hyper expensive mega cap techs and start looking for other areas, including areas that pay nice dividends.
And H&R Block, we're all looking forward to tax season. What attracts you to this name right now?
Yeah, so this stock, again, is down about 40% from its high. Wow. It's paying a 4%, about 3.5% dividend, about 8 times earnings. Very, very cheap. The concern has been that, AI is going to make doing your taxes a whiz. Well, I think that is an exaggeration. I also think with the One Big Beautiful Act bill that's been enacted, there's going to be some additional provisions that people are going to want help on. H&R Block is an iconic name. That business is growing. In fact, it's projected to grow earnings in the low double-digit percentages for the next 3 to 5 years. It's also a relatively small company that could easily be put into the pocket of one of these large financial institution players. With tax season coming, I think they're going to see a surge in business. They need to stay focused on that. And I think this is a nice way to hang out and collect a nice dividend in an otherwise very pricey market.
That was David Dietz, Chief Investment Strategist at Dietz Wealth Management Group. Coming up, Disney reported a strong first quarter, but is preparing for a bit of a shakeup in management. We've got more on that right after the break. Welcome back. Disney beat estimates in their first quarter. Most of the company's profits came from their parks and cruises unit, led by Josh D'Amaro, who is set to succeed the current CEO, Bob Iger, later this year. And we got more from Ken Leon, Director of Research and Global Fundamental Research.
It's the beginning of a new fiscal year, and it's one where we really didn't see all businesses firing on all cylinders. It's also a transition year, as noted, with a change of management. All that leaves investors, I think, a little bit questioning execution risk here. We certainly did see some improvement in operating income, particularly in the streaming business, Disney Plus. But overall, there's lots of puts and takes. Disney with sports segment, with ESPN, it's a tremendous franchise to have. But the sports right cost of getting major leagues has added to expenses and put some pressure on operating income. So I think in total here for Disney, it's how do you get all the different businesses moving in the same direction so that we have a strong quarter. That was not the case with the first quarter just reported.
Can you remind me, are investors still worried about streaming and the enormous investment there and the risk that it won't produce returns?
Well, they are. And you just can't drive subscriber growth without really having a good business and generating positive operating income. It's interesting. Disney has followed Netflix and not really disclosing subscribers anymore. And they just point to nearly a doubling of operating income in the quarter versus a year ago, and getting those margins up to about 8.5%. So that's pretty good. There's more work to be done there. But also, Disney provided less information related to, they have a legacy business, which is the broadcast network business. And that showed, again, a single-digit decline in advertising. So the pivot is happening. And Disney, of course, has to really orchestrate strong improvement in the streaming business because the networks business is still declining.
And it was interesting that the foreign visitors, lots of Canadians, are skipping America as a destination right now for their travels, and that is not great for the parks business.
Well, you're right. It's not only coming to the domestic parks, but its attendance has been not as strong as expected. Even in Florida with Disney World, for average Americans to take their family to the parks for 1 or 2 days has gotten too expensive. Mm-hmm. And I think that has impacted the ability of getting stronger revenue growth, but also as they have large capital investments. So, you raise a good question, because really the strategy and North Star, if you will, for Disney is the theme parks, and they expect to spend $60 billion over the next 10 years. Wow. With new venues and improvements. And then, of course, outside the U.S., the image of the U.S., and Disney is strong, but you watch how they do in markets like Shanghai or in Europe and Paris and anywhere else. These become issues.
The longer term, would you be a holder of Disney? At one time this was a stock, well, that may be going back more than a decade. People thought, well, Disney, that belongs in every portfolio.
Yeah, so, as investors, we look at Disney in terms of when could they have attractive returns on invested capital and the ability to generate not only higher profitability, but return of capital.
Coming up, we will get some strategies for retirement planning. We'll be back in a moment with more on that. Retirement planning might be moving higher on many Canadians' agendas, so we sat down earlier with Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, to discuss how to prepare and position yourself for what's ahead.
If you are contributing to your RSP and then you're planning to reinvest that associated tax refund, the math does actually favor the RSP contribution a bit, but I can't discount the TFSA. It adds a lot of flexibility for your portfolio as well as your eventual retirement and estate planning.
You say another consideration, another good one, is a spousal RRSP. What is that?
Yeah, I think there's a few additional considerations that people should be making with the March 2nd deadline for RSP contributions. Spousal RSPs are one. You see those where one spouse has significantly higher income than the other. This allows that spouse to contribute to the RSP, receive the deduction in their name, but then the eventual withdrawals for retirement are taxed in their lower income spouses' names. And the other caveat there is, and one that people don't often take advantage of, if the two spouses or people in the common law relationship are of different ages, say one person is now 73, their wife is 66, well, me as the 73-year-old, I can actually contribute to a spousal RSP, get a deduction, and my wife would get taxed on that when she converts that to a RIF account later on. That's something that wouldn't be available to someone if they just held an individual RSP. The other consideration, and I think it's very topical because of some of the emails that go out this time of year around RRSP loans from all the big banks, and do they make sense for you? Most of the time, I would actually say probably not. Ideally, if they can work the math if you are contributing your own money as well as doing the RSP loan to make sure that you can pay off that loan immediately. But otherwise, you might be stuck with some additional borrowing that you hadn't anticipated.
Okay, so for people who are maybe nearing the age of retirement, getting close, starting to look at it, what should they be looking at?
Yeah, I can't overstate how important it is to plan properly for retirement. And I really think that there's a missed opportunity that a lot of Canadians sort of in that 50 to 60-year-old range are missing out on. And I think that's partly because something I'm seeing more and more these days is that people are looking to retire early, whether that's age 60 instead of 65, or they're looking at doing some sort of phased retirements where they're stopping full-time work at age 60 and they're going to work part-time for a few years thereafter. And one such strategy that can be really important is actually called the RRSP meltdown strategy. And what this does, and it's very specific to the individual and to the household, but it requires withdrawing from your RRSP before converting it to a RIF or before you're even retired in some cases. And it's especially valuable for people who have really great pensions or people who are retiring with significant TFSA contribution room available. And what it does is it can significantly lower the household tax bill over your life. It can also increase the flexibility of your portfolio because if you're someone with a great pension, eventually you're going to be forced to take those RRSP or those RIF withdrawals later on in life. And that can push you to a higher income level than you otherwise may be comfortable with or happy with because you're paying more in taxes. It also exposes you to some additional old age security clawback after the age of 65. So it can make a material difference. And I see it pretty frequently where someone's sitting in front of me and they're 70 years old, 75 years old, and we're going through some of the opportunities that they may have missed out on, and all of them say, I wish I had made this consideration earlier because it can be a big impact.
Do you think people, like when they say I wish I was making this consideration earlier, we hear people that are maybe closer to our age or maybe not planning for retirement the way we should be, or do you find people even who are in their 50s and 60s starting to look at retirement? Are they still planning accordingly, do you find most people? For most people in the younger cohort, I would say that maximizing your registered accounts should be your primary objective between the RSP and the TFSA. Depending on your stage of life, I think there's some additional considerations for contributing to your RSP itself. For instance, if you're someone who is newly out of school, you're starting your career, and your income expectations are sort of up and to the right, then it can make sense to even maybe hold off on contributing to your RSP, let that contribution room grow, and then take advantage of it when you're in your higher income years. But for most people, I would say just focus on maximizing those contributions. And then for people who are sort of in those later stages, that's where I would say the sweet spot is for having these considerations, because you may determine that your RSP contributions are not optimal because of a great pension or a locked-in employer-sponsored plan that you have through work, stock options. There's so many different considerations apart from just making sure that
you're putting the money towards these different accounts.
And just lastly, like some Canadians might have been getting notified by their banks that they're eligible for RRSP loans. What does that actually mean?
So RRSP loans is effectively you can borrow to then contribute to your RRSP. You would use the associated tax refund in a couple months to pay off that loan. The problem is if you take out a $10,000 loan and you just use that as your only contribution for the year, you're not going to get a $10,000 refund. Right. So you're going to be stuck with a bit of that loan balance, even if you put your full refund towards that loan. So when I say that it makes the most sense for people who are contributing their own money as well, maybe you put $25,000 in this year and you want to bring it up to an even 30. That can make sense because your associated refund overall is going to be more than $5,000, depending on your tax bracket. But for most people, I would say it doesn't make the most sense. And ideally, you're using your own capital to make these contributions.
That was Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Well, Market Call is coming up next. Today on the show, we have Barry Schwartz. He's the president and CIO of Baskin Wealth Management, and he will be taking your questions on North American large cap stocks. But before we wrap up here for the day, we'll take one quick look at how markets on Bay Street and Wall Street are trading. We'll start with the TSX, correcting slightly after a big sell-off that we saw on Friday. We know materials stocks are also showing some gains today on the TSX. You can see it's up 0.7% at the moment. And if we take a look south of the border at some of the big U.S. markets today, also rebounding after some recent volatility, helped by some strong earnings in certain sectors. S&P 500 is up by 0.5% right now. Dow Jones up by 0.8%, and the Nasdaq up by 0.6%. And thanks for watching Morning Markets. We will see you tomorrow.